1,300 pages of changes and do it in 20 minutes, but I think we can push through it. It happened, obviously there was a massive tax change that happened in December, late December, and it's probably one of the biggest changes that's been happened in tax since 1986 in the U.S., so it's a big deal. And all my staff was thrilled that they got to do this over the holidays instead of being bored at home or in Florida, so we're all thankful for that. I'll go through some of the changes. As I said, it was December 22nd, and most of the provisions are effective for individuals for 2018 year, so that would be the year starting now, so not on these tax returns, but later. And then it's a period of time this bill goes through 2025, which we'll see what the rules are then if we're still here. And then most corporate changes are intended to be permanent, though, so they don't expire. So what were the major changes for individuals? There's actually new tax rates and new tax brackets. They increased the standard deduction. They took away the exemptions and they changed some of the things for kiddie tax. So we'll go through that. They also increased the child tax credit. They limited a lot of deductions and in which are some very severely actually. They increased charitable deductions, and one of the big things as well is they suspended the alimony deduction, so payments to alimony are not deductible anymore, which is very big. So there's a lot of changes for the way the return is calculated. Looking at the brackets, actually, I did this little chart here of the old brackets and new brackets. They increased the brackets and decreased the rates. So it goes now to 37% tax over $600,000 when it was 39.6% tax over $470,000. So it's much higher thresholds. And I was doing some calculations yesterday, which is interesting. And if you were to make $100,000 jointly and you get a $25,000 deduction, like which we'll see, then you're at the 12% tax bracket still. So you could make $100,000, and I think the average rate works out to about 8% tax you'd pay on $100,000, which is kind of similar to Canada, but not quite. So these deductions are really important. So you're at $300,000. You have the 24% bracket still. And the capital gains rate, which was 20%, now moved up to it correspondingly moved up to the top tax bracket of 20% at $600,000. It's when you're at the 20% capital gains rate, and you're at the 0 or 10 or 15 before that. And qualified dividend is the same. So that's a big deal too. The one thing that I was kind of surprised it changed, and this is a big problem with Canadians particularly, is this net investment income tax. So basically this was brought in to pay for their healthcare system, and it was going to be a 3.8% tax on everyone's interest, dividends, capital gains, rents, and royalties if your income, total income was over a certain amount, and it was 3.8%. Why this was a problem for Canadians is that you weren't allowed to use a foreign tax credit against it. So if you paid all your tax in Canada, you couldn't wipe out this particular tax. And I really thought this was going to be gone, but it wasn't. So that's still a problem with this one. And it actually could exacerbate the problem because of the deductions that are not allowed anymore. So this is not good for Canada one. So anyways, I mentioned that the standard deduction increased substantially. So it used to be $13,000. Now it's $24,000. So the first $24,000 off your income you pay no tax on if you're filing jointly, or $12,000 if you're single. So that's a huge thing. And they limited the exemption. That used to be $4,050 for every dependent and your spouse that you had and yourself, and that's gone. So that may work out better or worse depending on how many kids you have. And the new child tax credit used to be $1,000 and refundable up to $1,000. Now it's $2,000, and so for every kid you get a $2,000 reduction. You can get a refund of a credit for up to that, and it's phased out. It used to be phased out if you made more than $110,000. Now it's phased out if you make more than $400,000. So the poor people that have a lot of kids, are $400,000 can still get it. The limitations on deductions, this is a huge difference. They're cutting down a lot of the well, these are the good things first, is there used to be a phase out if you made too much money that your itemized deductions got smaller. They're taking that away entirely. You're only allowed to donate up to 50% of your AGI and get a deduction for that. You could donate more, but you get a deduction for the 50%. Now it's to 60. And then medical expenses used to be to the extent it exceeded 10% of your income. Now it's 7.5%. And they're actually backdating that a year. So for this year's returns, it's 7.5%. Some of the negative things, again, the alimony is no longer deductible, so that's That's a big deal. This is a huge one. The state and local taxes are capped at $10,000 now, and that includes property taxes and all that sort of thing. And so what was happening in the U.S. is people were trying to struggle to pay before next year's tax, before December 31st, and the IRS came back and said that that only if it was liable to be paid could you get the deduction. So some of the states, New York and I believe New Jersey, actually passed a law that made all the taxes liable on December 31st, so people still prepay it and get the deduction for this year, because next year it's capped. There's only a few states where the average property tax is more than $10,000, but that's a big deal. No more moving expenses, and a big one for us here is now you can't use foreign property tax on your U.S. tax return. So that's a thing. The mortgage interest deduction used to be a deduction for mortgages of up to $1 million. Now it's down to $750,000, and then all the miscellaneous deductions I used to be able to get, tax preparation fees, home office, business expenses, are now no longer deductible. So thinking about this from a Canadian perspective, what normally would happen on a U.S. return is we do the Canadian return, assuming person only worked in Canada, the U.S. return, and we take our Canadian tax, which was most often higher than the U.S. tax, and it would wipe out the U.S. tax. As the U.S. tax gets, if the Canadian tax was based on these huge deductions, possibly not mortgage interest, but other ones, then if the Canadian tax gets too small, there might be a problem. And we either don't have enough to wipe out or don't have very much carry forward, which could be resulting in a problem. So these are some things that we should be concerned about. The estate and gift taxes, it is going to be eliminated at some point, hopefully, but for now they just doubled the exemption. So the first $11,180,000 of either gifts or estate is not subject to it. Then there's a special rule for Canadian spouses. If you leave your assets to a Canadian spouse, you get another $11,180,000. So we're looking at this applying to U.S. citizens of Canada of more than $22 million or so, which cuts down by a few the number of people that applies to. And trust rates, those shrunk. The rates went down a little bit, but the brackets are still very small, so we don't get the benefit. It's just 37%, which is the top income tax rate. Kiddie tax, this is where the tax on unearned income of a minor, you're allowed to tax it at the parent's rate, and now the new rule is that you have to tax at the trust rates, which I just showed you were much, the brackets are much smaller. So they're kind of not favoring kids who have net unearned income, so like interest, dividends, that sort of thing. So that's a big change. And I mentioned about the estate and gift taxes. So Canadian people with U.S. property. So if you're not a U.S. citizen, it's only U.S. property and specified U.S. property, and then you get this bigger exemption now. So there's an example there of if you have a small amount of U.S. property, then the exemption is bigger. It's much bigger, and so it should cut out most of the U.S. estate tax. Now, some of the big changes were in corporate tax, and they really rejigged everything with corporate tax. And the problem, I guess, to say why they're changing all this stuff is the U.S. had a very low personal rate, but very, very high corporate tax rate. So a lot of companies were trying to not have to pay U.S. tax by using different kinds of structures. For individuals that have small businesses, you'd almost never use corporate structures, use pass-throughs or things like that, as well as companies were having their head offices in other countries to be able to not have to pay tax on their worldwide income to the U.S. So the previous government said, well, we're just going to make it more punitive to have offices outside the U.S. And this government said, why don't we just lower the rate and have everyone bring the money back to the U.S. And so that's what they're going to try now. So it used to be $35,000 rate, and it went down to 21% rate for corporate, as well as the dividend received deduction. That's basically if you have multiple corporations giving the dividends from one to another, used to be is only exempt from tax if you have more X amount of share ownership, 80 or 70, and now it's much less that you own. So that's really big. Net operating losses change. You were allowed to before carry it back to and forward 20, and now you can't carry it back, but you can carry it forward indefinitely. They repealed this deduction for domestic productions based on goods or work. And then one of the biggest things is with foreign tax, and this is what's kept us busy for many weeks, is this change, and it's gotten a lot of not a lot of media, which is surprising because it's such an important change, but it affects not so many people in the U.S. as people outside the U.S. The other problem with this we're going to find is they've given us no guidance and it's written kind of poorly. So we're going to get some guidance, hopefully, but it might be too late because we're going to be given this guidance probably over the next couple years. And so it's a lot of interpretation, which I'll show you of what you think it means and everything. To do a little background on it, so basically if you have a U.S. citizen, we'll say, that owns a foreign corporation, or a U.S. company that owns a foreign corporation, you can't defer tax or income in that corporation to the extent it has its interest, dividends, capital gains, rents, and royalties, which we call Subpart F. That all has to be put on our personal or our U.S. citizens' return. And it's similar to the FAPI rules in Canada. So that's the way it's been going on, and everything's been going since the 1960s with that. But now they're changing that, and they don't want people to defer money at all in foreign corporations, including the regular active business. And so they're going to have some system of paying tax on that, even though it didn't come out to the person or the other company. So that's a really big thing. So what the problem is now is that they're going to go to this system. They want a catch-up tax, and basically they want to tax anyone's retained earnings that was accumulated from 1986 to December 31st, and then have this one tax on it, and it's going to be either 15% or 8% depending on the calculation, and that's a huge deal. There's a lot. Imagine all the U.S. citizens that live in Canada that have private companies. Maybe they're a doctor, maybe they have a small business or whatever, and they may have millions of dollars of retained earnings in there. Well, that's going to be subject to a one-time tax of 15.5%, and that's a check that there's no foreign tax credit against. For all the Canadian tax paid inside the company. So that's a huge problem. And then, as I mentioned there, so what they did, though, is they said it's the greater of November 2nd or December 31st. Remember, they put this out on December 22nd. So the easiest way around that was to strip out the company right after they made this law. So then they put in there, as we read later, that it's whichever was bigger last month or December 31st. So that's a problem. You can't do that. This is where I spent actually days and days reading this 3 lines, because this is where it says poorly worded. So we need to figure out who this applies to. And it says here that it applies to any controlled foreign corporation. A controlled foreign corporation is one where a U.S. person owns more than 50% of the company. And it says, and any foreign corporation with one or more United States shareholder. And why it's difficult is in the tax law, when the word and is there, it usually means both things have to exist. But in this case, reading this, I think it meant to be as well as any instead of and there's been no guidance, and I've read commentary from many law firms and accounting firms, and no one has a clear consensus, and it makes a huge deal whether you have to have a U.S. corporate shareholder or not. So this has been a controversy with the one. We've been reading this like there's a Zapruder film and watching it over and over, this one slide, and figuring out what it means. And so it's been interesting, and hopefully we're taking the position that it means any CFC as well as any foreign corporation, but we could find out that it meant you had to both of them, which would apply to almost nobody in Canada. So that's a problem. The other problem is that we used to get around these rules sometimes by giving all the votes to one person who was not a U.S. person, and that was because it was always by votes, whether you determine this. Now they changed it to votes and value. So you can't give shares that are worth 1 million votes each or something to somebody else and then get out of these rules. So they stopped that one as well. So that's a change. And then actually there's more slides hundreds more slides, but to continue on, they're going to be from now on taxing these foreign corporations on personal returns on a current basis, which that would really negate a lot of Canadian tax planning with using personal corporations and things like that. So that's the fun we had. And if you have any questions, obviously email me or call me or something like that. And, okay. Hate it.